Okay, let's dive right into this. Welcome to The Explainer. Today, we're unpacking what has to be one of the most fascinating and honestly totally baffling financial maneuvers in modern corporate history. Picture this: June 2026, SpaceX pulls off a historic initial public offering. But what the company did literally days after securing a mountain of cash, it left global markets completely scratching their heads. We're going to follow the timeline, look at the data, and try to solve this $86 billion paradox together.
$86 billion. Just let that number sink in for a second. That is the exact amount of cash SpaceX raised during its NASDAQ debut on June 12, 2026. I mean, we're talking about the largest public stock market debut ever recorded, instantly giving the company a staggering $1.78 trillion valuation. Literally overnight, SpaceX's corporate treasury was packed to the absolute brim with fresh equity cash from investors who are just desperate to own a piece of the space economy.
But then the narrative hammer drops. Just 10 days after raising that unprecedented mountain of cash, the company turned right around and initiated a massive $20 billion debt issuance. Yeah, you heard that right. Tens of billions in fresh stock cash, followed almost instantaneously by a massive corporate borrowing spree.
Which brings us to the core mystery we need to solve today. Why borrow billions when you're already rich? Seriously. Why on earth would a newly public trillion-dollar company, with a treasury overflowing with investor cash, immediately plunge itself into massive debt? On paper, it seems completely backwards. But to figure this out, we actually need to look past the rockets and the satellites. We need to rewind just a few months before the IPO to the start of 2026 to see what SpaceX was quietly buying.
Section 1. The AI Acquisition Catalyst.
Let's move to the timeline and see how this all builds, because when you map it out, the market whiplash really starts to make sense. In February and March of 2026, SpaceX executes a massive merger, acquiring Elon Musk's AI startup, xAI. Obviously, an acquisition like that requires billions in immediate cash. Then, boom, the June 12th IPO hits. By mid-June, management is aggressively locking down credit ratings, and by June 22nd, the bond sale is officially launched. It's an incredibly compressed, fast-paced timeline, and it totally explains the absolute whiplash the financial markets felt.
Now, to fund that sudden xAI acquisition back in March, SpaceX had to take out what's called a bridge loan. If you're not familiar, a bridge loan is exactly what it sounds like. It's just a temporary loan used to bridge a gap until permanent funding is secured. In this case, a $20 billion temporary bank loan was hovering right over the company's head, set to mature in September of 2027. And, SpaceX simply couldn't afford to just sit around and wait for that deadline to fix this massive liability looming on their balance sheet.
And this brilliantly illustrates exactly why that temporary loan was so necessary. Just look at the sheer scale of these AI infrastructure costs. In the first quarter of 2026 alone, SpaceX blew through $7.7 billion on AI capital expenditures. This cash was basically poured straight into heavy computing infrastructure, like their massive Colossus 1 facility. Now, put that into perspective by comparing it to their entire operational loss for the whole year of 2025, which was $2.59 billion. The AI spending completely dwarfs their traditional space operating losses. It's wild. Developing AI just requires an unprecedented, almost unimaginable amount of cash. So, the executive team is sitting there with a wildly expensive short-term loan maturing soon and massive ongoing AI costs. How do they fix it without draining their shiny new IPO money?
Section 2. Securing the bond deal.
Let's break down the actual mechanics of how their corporate finance team solved this. They essentially converted a temporary headache into a long-term strategy, doing it in 4 deliberate steps. First, they secured investment-grade credit ratings, we're talking BBB or BA1, from the major agencies. And keep in mind, they didn't get these ratings just because they build cool rockets. They secured them on the back of highly predictable, contracted revenues, like their massive $1.25 billion monthly deal with the AI firm Anthropic. Once rated, they moved to Step 2, issuing notes. Then Step 3, using that fresh cash to pay off the original lenders. And finally, Step 4, committing to long-term interest payments.
Let's zoom in on exactly what they issued in Step 2, senior unsecured notes. Think of this as a very formal, very large corporate IOU, sold to institutional investors, your big pension funds, insurance companies, folks like that. Senior unsecured basically means that if the company ever goes bankrupt, these bondholders get to cut in line. They have priority over regular stock owners to get their money back. But here's the kicker. There is no physical collateral. No rockets or launch pads are backing this up. Selling these specific notes gave SpaceX the billions in cash they needed to instantly wipe out that stressful temporary bridge loan.
Of course, in exchange for providing all that cash, SpaceX agreed to pay those bondholders a set, fixed interest rate of about 5.35%. And honestly, this is where the genius of the maneuver really shines. By locking in this fixed rate for the next 10 to 30 years, SpaceX completely walled off their AI costs. They protected their $100 billion in post-IPO cash strictly for core space operations, building starships and launching Starlink satellites. The stock cash funds space. The bond cash funds AI. On a spreadsheet, it's a strategic masterpiece. But, as we know, the market isn't just a spreadsheet. It's driven by human reaction.
Section 3. Market Backlash and Fallout.
Now, what's really interesting about this slide is how it shows the immediate, dual reaction across two completely different markets. Over on the equity side, investors absolutely panicked. I mean, seeing a sudden $20 billion debt load get slapped onto the books just days after an IPO, that caused SpaceX stock to plummet 13 to 16%, dropping from a peak of $225 down to around $153 a share. Equity investors were sweating the aggressive leverage. Meanwhile, over in the bond market, things were flooded. Institutional demand was actually so high that SpaceX upsized the deal to $25 billion. But then, fast money traders swooped in to flip those bonds for a quick profit, which ended up weakening the secondary market and driving the effective yield up to near 6%.
So this whole maneuver created some pretty serious, real-world trade-offs for everyone involved. For SpaceX management, the benefit is obvious. They get to keep their IPO cash totally untouched. But the trade-off? Eliminating that 2027 default risk meant taking on massive long-term debt. Now for you, the stock investor, you get to keep the incredible upside of space travel and internet monopolies, but you are now highly exposed to $29.1 billion in total debt, not to mention a highly volatile AI market. And for the bond investors, sure, you get steady interest payments, but you're facing immediate paper losses if you try to sell your bonds early at a discount. Understanding these structural trade-offs is absolutely crucial, and it brings us to the final reality of this explainer.
Section 4. The massive risks ahead.
Because, as you might guess, this level of financial engineering comes with some very serious long-term threats to the company's sustainability. Let's look at the data exactly as the credit agencies view it. They note 4 major risks here. First, no near-term profitability. SpaceX posted a net loss of $4.9 billion in 2025. Second, a massive interest burden. Borrowing at nearly 6% means they have to pay out well over $1 billion in interest every single year, heavily dragging down cash flow. Third, extreme key man risk. Agencies specifically note that the company is deeply dependent on Elon Musk, which presents major governance questions when you're holding bonds that don't mature for 30 years. And fourth, weak ESG ratings. MSCI actually gave SpaceX its lowest environmental, social, and governance rating, a CCC. Now, we're just looking at the market data here, but this is a critical point because new 2026 regulations legally ban a lot of large investment funds from holding corporate debt with low sustainability scores.
So, the crucial point is, SpaceX successfully leveraged long-term corporate debt to bankroll its massive artificial intelligence ambitions, cleanly protecting its IPO cash for things like Mars exploration and satellite networks. In a way, they totally solved the paradox. But it leaves us with one final, unavoidable question. With $29.1 billion in total debt, a suddenly unpredictable stock price, and immense interest payments looming every single year, is SpaceX flying a little too close to the sun? It is a remarkably high-stakes gamble, merging the cash-burning realities of AI with the capital-intensive business of space. Thank you so much for joining me for this explainer, and remember to always keep questioning the numbers.